Good afternoon, ladies and gentlemen. Thank you for joining UOB for the start of the year market outlook seminar. We have had a very exciting start, of course. So for today, we have two of our key economists who will assist us to decipher the tea leaves. We will have Teck, our head of research, who will give us a quick rundown first on the macro outlook. And then we have Mr. Peter Chia, who's our senior FX and rate strategist, and he'll give us an update on FX and interest rates. Then we will group together for a quick Q&A at the end of the session.
And my name is Teck, and thanks for joining us today for this start of the year webinar by UOB Global Markets. So what we let's look at the Fed first, and then we'll talk about our neighborhood a bit, Southeast Asia. And the final one will be on China, which is also very important in our part of the world, right? Second largest economy in the world. So let's start with the Fed. How many more rate cuts are we going to see after 3 cuts last year? So for our view is that our team is that we are looking at another 3 more rate cuts, 2 more rate cuts for this year in 2026 at this point, because there is a lot of uncertainty, not just what Kevin talked about just now earlier on the geopolitical side, and also within the Fed itself, it is not uniform in their view, right? It is not all in sync in their view. The reason why they are not in sync is because we are going to get Fed chairman soon, new Fed chairman in May, and also within the Fed, all the members of the Fed, they have different view of looking at different things. Now our view is that 2 more to go this year. Then let's see what the financial market is looking at this point. So the financial market, this is the implied probabilities of Fed rate cuts. How do we read this? We can get this information from CME. Here is the link at the bottom. You can go to CME. What we are seeing here is that on the screen, all the meetings, the 12 meetings for the year, and the current Fed funds rate after the 3 rate cuts is 3.5 to 3.75% for the Fed funds interest rate. Now, let's take the 3.75 first. I think it's easier to understand. Now, the current rate is 3.75. So all these percentages you are seeing here is a probability. On the screen, you see 83.4%, meaning that for the next meeting, this is the Jan meeting around 28th of January, 83% probability that the rate will be unchanged. That's what it is, right? That's what the financial market view as of last night. That's what they are saying in their betting, 80 over percent, no change. And one more column down is 25 basis point cut. So all the numbers are 0.25% lower if you shift to the across the left. So that means 1 rate cut here, 16%, roughly around there. So the financial market convention is that if anything that is above 70%, most likely it could happen, right? Most likely, especially if you are closer to the meeting, anything above 7, more the certainty of that action or that event will take place, right? So right now, 83%. Of course, these numbers are going to fluctuate from hour to hour, day to day, second by second. Yeah. So this is just to give you a sense of where things are right now. January, 83% likely to stay, no change. But if you look across, if you look across on the left side, right? So this 3.6% is roughly about 3.75%. And then if you look at the changes by June, it seems that there will be a 1 rate cut already. By June, by April, June, that's where the Fed funds, that's where the Fed chair will be appointed, right, in May. So the financial market is probably betting something along this line, that something could happen here in June. And then you look further down, another 25 basis point will be somewhere around here, and then another 25 basis points. So end of the year, right now, as of last night, financial market is betting by end of the year, Fed funds rate is going to be close to 3%, meaning about 75 basis point cut, that's being priced in. How strong it is, let's take a look. If you look down here, by June, by April or June, you can see that there's a shift in the probability to about 16%, no change, right? So that meaning that 80 over percent, right? 80%, 80 over percent, there is some kind of change, whether one or two rate cuts. So that's how we look at this. So if you go to the website here, it's a public website. You can go in and take a look at your free time. It is a bit more complicated because it's not. It is ranked by page, month. It is ranked by meeting. So you have to click through the different meetings. Here we summarize everything onto one page. And this chart is actually available on our daily report that we sent out. Right? Every day we send out this daily report. It's at the back. You can see we refresh it every day. So if you are not already receiving it, please talk to your sales person or your RM to get on to the mailing list to receive this on a daily basis. Of course, you can go to the website, take a look. So that's what the financial market is looking at right now. About 2 to 3 rate cuts by end of year. We are looking at about 2. Again, subject to uncertainty because the new chair can get very aggressive. If that's the case, then we have to adjust our calls accordingly. But again, that will come with a cost to the US. It is not so easy to bring the interest rate down into a very low level. That is not as simple as that. So the new chair will have to weigh carefully if he wants to be very aggressive. Right. So where is the division in this case here? Let's take a look at why is it divided within the fact that just simply we just show you 2 simple charts. Why is it that is divided, right? It is not uniform in their view, whether to stay to cut further or to pause, right? So on the left side, there's a jobless rate. Now the jobless rate here, I segment it into different rate age categories. So the youth category here, you can see the youth category, the blue one is actually picking up very strongly. The number that is often quoted is the one that is the headline, 4.6%, and that's where I think the headline has the black one also has been creeping up, right? The latest 4.6%, so it has been creeping up already. It is not serious enough for let's say for the Fed to do something aggressive. Oh, labor market is not doing well, therefore we have to take some action. So it is not as serious as that because non-farm payroll, the job creation, I think is continuing. Just that on the unemployment side, we are seeing some weakness developing, especially on the younger generation. Right, the younger cohort is seeing much higher, and the increase in the jobless rate is very fast. Right, so that's on the labor market. So typically, with a weak labor market, you will argue for more rate cuts. If it is a stable labor market, like in this case here, if you just look at the headline, may not be so convincing to cut interest rates. So on the right side is the inflation. So they have these 2 mandate, right, for the Fed, 2 mandate, unemployment or the growth, and also inflation. Now inflation is quite interesting because if you look at the services index, the services index has actually been softening. Right, inflation has been softening on the services side, or your medical services, your healthcare costs, your education, transport costs, and things like that have been coming down. But the goods prices here at the bottom, what you see is that the goods prices actually has been creeping up, and the action has gone very quickly. It's because of around here where the US declare all these tariff, right, all these tariff rates, and that's having a real impact on goods prices. So consumers in the US are actually facing higher goods prices, mostly because of this tariff. Now, how is this going to be evolving? And again, that's subject to division and argument as well. Right? Some will be seeing, oh, it's going to flatten out because these year-on-year effect will start to come in this year. By April, you should be seeing the prices not moving as high as what it did a year ago because of the base effect. And prices, unless another round of tariff coming in, otherwise prices should stabilize. And then if this trend continue for services, and that means that the inflation environment will be a bit more muted and does not require aggressive rate cuts. So, but some will be saying, oh, we shouldn't be doing any more rate cuts because the prices are still high, right? We need to make sure that inflation does not return or turn even worse. So we should just stop all these rate cuts. We should pause and take a look and wait to see how they are. So this is the kind of uncertainty that we are facing right now, and that of course will cause market volatility. Because if you have somebody, like for example, Power saying something one way or another, that will, in a way, will swing the market one way or another, right? But of course, we know that the Power term is ending in April and May. A new person will come in May, so that would be another source of uncertainty until then, right? So that, but for now, we are keeping our call for 2 interest rate cuts for now. All right. So the next segment, so this on the interest rate side on the US. The next segment is on our neighborhood, China, ASEAN, and also China. So my title here is that we should just, we are actually keeping calm and carrying on despite the tariff that we have. And this is the chart that the keep calm chart that we have to carry on. This is, I think, if anything on this deck that is worth keeping, my section. I think this one will be one that you want to keep for reference. This is our outline or our forecast for economic growth forecast for 2026, basically, right? Because we already passed 2025, but most of the numbers are not in yet entirely. So we are still waiting for final numbers for 2025, so we can put it as some sort of forecast. 2026 definitely is a forecast for this year. And what you are seeing here is that for ASEAN 6, right? Just take a look in the middle for ASEAN. Growth will be stepping down a bit, but overall, in this part of the world, overall, I think things are still, a bit of a moderation and not a sharp downturn that we are expecting, right? Some moderation, so we shouldn't be worrying too much about it. The business environment, I think overall, should be still okay. Now for China, also a bit of a stepping down as well. Last year, 2025, I think China should be able to meet its 5% target. Later I'll explain a bit why that's the case. For this year, I think for this year we are conservative, so we are stepping down a bit of to 4.6% and see how things go, because for the big picture here, last year, the reason why we did quite well last year, for example, China able to meet its target despite tariff, and Singapore, take a look at Singapore, did even better than compared to 2024, right? 4.8% in 2025, right? So we expanded very quickly last year, much better than 2024 on the back of strong exports that we have been seeing for most of these countries here. Okay, Vietnam is another one, surprisingly strong. Exports have double-digit growth for exports in 2025. So is it going to continue this sort of pace? I think unlikely to be the case. So at least we should see some moderation going forward. So this is the chart summarizing almost everything that we have for our forecast for Southeast Asia. Now, this is a trade chart. Now, the trade is for Southeast Asia, the ASEAN 6. How are they performing? As you can see from the chart, just the 2 lines will show you the exports in Southeast Asia and also imports in Southeast Asia have been going on kind of without much disruption from Trump tariff, right? So has been performing quite well, not just individual countries, but overall for the entire group. So the environment is a strong trade environment in 2025. Is it going to continue? Is an open question. This year we have to see. Now, why is it that we are performing so well? Partly because of these supply chain shifts. You talk about these supply chain shifts coming out from China and then selling to the US, and we are seeing all this investment coming in because we want to set up factories here. Later I'll show you some numbers to prove this point. And also, of course, the other one is the AI demand, right? The AI demand, you hear about all these expensive memory chips, go to Silicon Square and all those things, expensive memory chips because of the demand from AI for the data centers, for all these AI applications, etc., that require more horsepower, more memory power, more compute and everything. So that drive exports in this part of the world and in China as well, right? So that's a trade situation. We should see some moderation unless demand really fall off sharply. But otherwise, I think we should see some moderation and not contraction this year. All right, inflation picture in Southeast Asia is actually quite benign. right? This inflation here, you can see that has been managed quite well. It's coming down from the COVID, after the COVID high, it's been coming down and staying quite well managed. That means that central banks have a lot more flexibility. Let's say if they want to cut interest rates, want to so-called ease policy, then they have much more room compared to if you are in a very tight situation, you cannot do much, right? So that is not the case for Southeast Asia, including for MAS as well. So that is something, the flexibility that the central bank has, and then they can have a bit more leeway to manage any situation that could come in, especially a negative situation, right? I just want to have two more points on Southeast Asia just to indicate what is the investor confidence. Just now I mentioned about trade, talk about supply chain shifts and all those things, and things seem to be looking good. And one of the key things that we should also watch out is the investor sentiment towards this part of the world, right? Especially this part of the world, investor sentiment. How do we measure that? One way to measure this investor sentiment, or how they look at the prospects in this part of the world, is through this foreign direct investment, FDI. Now for 2024, these are the ones that these are the folks that invest in factories, plants, and buying equipment, and setting up warehouses, etc., etc. This is the kind of investors. We are not talking about those in the financial markets, bonds, equities, or the like. So these are the investors that they have a long view of the place before they commit, because their factory will probably take 3 years before they finish building and start operation in the 4th year, 5th year, right? So these investors are very sensitive to sentiment or the prospects, especially. If this place have no prospects, no matter how attractive it is, they probably won't come in, right? So this is the this is the type of figures that data that we monitor closely. For ASEAN in 2024, the inflow was 225 billion US dollars, about 10% increase over 2023, right? 10% increase. The whole world has about 1.5 trillion inflow recorded, right? For each country, it's about 4%. So we are 4% gain. So in 2024, we grew much faster, and US has been the big attraction for investor in the US. Attracted about 280 billion, etc. Right. So now this place Southeast Asia, ASEAN, at the top of the league in terms of foreign inflows in investment. Right. So if you look at other places for investment, Latin America or Europe, etc., etc. Right. So there are many places for investors to consider, but Southeast Asia is consistently near the top or at the top. Right, so this also places Southeast Asia at the top of FDI destination. Right, so all this money that comes in, generally they will park in Singapore because of financial center status, gateway to Asia, blah blah blah. That kind of reason. So generally, money will first come into Singapore and then spread to the rest of the world. Now, Indonesia, Vietnam are the top investor destination, and Malaysia and Thailand as well. The rest of others, just give you a reference. So that is the picture here. Investors were confident in 2024, put in quite a bit of money here, put us in at the top of the league in Southeast Asia. Now, why are you telling me all this, right? You are asking, Trump came in 2025, created a lot of problem. How about 2025? Now, unfortunately, that kind of numbers, these sort of numbers only come out once a year, and typically they will it's from United Nations. It will only be published in around June or July. For 2025, for the picture, we need to wait until middle of the year to have a look. Now we have something called balance of payments figures that approximate that kind of numbers, approximate only, not exact one for one, because of all these definitions and all that. So far, 2025, how is the situation holding in Southeast Asia? It's actually for Southeast Asia, it's actually not bad. It's about same period. So the red one is for 2025 latest, first 9 months, and blue one is 2024 first 9 months. So far this year, for the first 9 months, despite Trump tariff uncertainty and also other negative factors, geopolitical factors or whatnot, the inflow has still has been quite good, and then it's up about close to about 10% compared to the same period last year. So that put us on track. That put us on track to beat or if at least meet what we had in 2024. So that put us on track, very close. So again, that shows investors' confidence of Southeast Asia in terms of a place to do business, a place to shift my production, to set up my factory or my warehouse, or to support my other partners, right? So that is a picture that we have so far this year, or rather 2025. I think it's still looking good despite all these uncertainty, and the inflows have been coming in very strong, right? Very strong based on this picture here. Now, how about over the next 10 years, 5 years, we actually we put out a report in November about the prospects into 2025. I won't go through the detail. If you want to go detail, the link is here for you to look at it. But overall, the prospects for ASEAN over the next 5-10 years are still positive according to our estimation. All right, so this is a growth forecast, and then this is the trade projections that we had over the next 5 to 10 years. Next 5 to 10 years. Now, the interesting thing, what I should say, is that 2025 we put out a forecast here about 4 trillion US dollars of total trade in Southeast Asia. Actually, by November, this figure has already been exceeded already. I think roughly, should be around in the 4+ trillion. So I think we are quite on track in terms of forecast and situation. I think you will about 50% higher, 40% higher in by 2030, 35 or so, right? So similarly for FDI, that's our forecast here. Next year, probably last year, 2025, likely to at least match or on track to meet what we had, what we saw in 2024. So the situation, I think, is still good. Why is that the case? Because supply chain shifts will continue to extend, and the investment inflows here, and also, of course, our fundamentals are quite strong. So the environment here is largely positive for this part of the world, and that will translate, right? That reflect in the currency situation as well. How various currencies perform partly also reflect on the fundamentals. I'll leave Peter later to explain to you or to analyze how that will translate into the currency movements into in this year. All right. So that's for Southeast Asia. The last bit that I have is for China. And for China, despite all the tariffs, the Chinese export still perform quite well. For the January to November period, is already up by about 5.4%, right? 5.4%. And our full year forecast for Chinese exports is only about 4%. So that is sometimes you may ask, wow, the Trump tariff didn't really hit China that badly. In a way, it hit badly, but not other ways. So how did it hit badly and not others? Now take a look at China exports breakdown by market here on this on the right hand side on the screen. At the bottom, this is a year-on-year, Chinese exports year-on-year compared to the same period 12 months ago. On the screen at the bottom, you see the US, exports to the US from China every single month, right? Every single month has been negative, double digit. So Chinese exports to US has been coming down significantly, right, on a year-on-year basis. But non-US markets, right? Non-US markets, take a look at all these non-US, all the white background numbers are generally quite good. Let's just pick an example. For example, Southeast Asia, ASEAN, every month either double digit or high single, right? So exports to ASEAN, non-Chinese, non-US markets have been performing quite well. So that explains why China, racked up 1 over trillion record high of its trade surplus in the first 11 months of this year, last year, 11 months in 2025, 1 over trillion. And that is despite Trump tariff. And also, if you take a look at 2018, since 2018, these numbers, the trade surpluses have been building up, right? Even during the COVID period, trade surpluses have been building up in China, despite Trump tariff, your trade tensions, tech sanctions, and all these other things that come in. And China has been able to continue to build its trade surpluses. One reason, of course, is China's production capability is very, very strong. Manufacturing capability. All right. So that is where I think things are helped with the trade with more non-US markets, trade with more non-US markets. For example, here I just want to show you an example. US importing from various countries, all the main countries. US import, this is a US, on the left hand side is a US import. The share from China has been dropping, the red one has been dropping. Now the share of US imports is only 9%. That means less than 1/10 of the US import came from China so far this year to September. Now, if you look at the past, about 20, even 20 over percent, that means 1/5 of what US imported used to come from China now is less than 1/10, less than 10%. Whereas what US imported from ASEAN has significantly gone up. Right, in the past, maybe a single digit, now is into the double digit range. So 12% of the stuff the US imported, more than 12% came from ASEAN so far in 2025, in the first 9 months, because the government shut down, so the data has not been updated to the latest. So this up until September only. So that is where the supply chain shift taking place. Used to come from China, now quite a bit of it coming from ASEAN and also Mexico as well. Now, so China is doing a lot more business with non-US market, particularly Southeast Asia. On the right side, this is China exports to various markets to ASEAN, continue to be very strong, and part of it is explained by the supply chain shifts. All the intermediate products shifted to Southeast Asia for final production, and then for export to the US. So if your company operates in this space, right, the supply chain shifts, whether you're supplying, whether you're doing services, support and all that, that will be the area that you will see a continued growth, because the trend unlikely to change anytime soon, at least for the next 3 years when Trump is around, right? So China exports to other markets, for example, US coming down, and also even with Japan as well. So ASEAN is helping to support as well these China exports. Okay, now I mentioned about non-US trade with China, and this is the chart that we have here. For example, this is a Belt and Road countries trade activities. China is doing a lot more work, selling a lot more, buying a lot more with Belt and Road countries. Right, this is in terms of the dollar value, just to give you a sense, dollar value, and pickup acceleration actually started around 2018 or so. Right, after 2018, things just pick up quite significantly. Now, the right hand side to give you a sense of a non-US markets impact on China is in terms of share of this China, and that's where I think the pickup again accelerate quite significantly after 2018. In terms of what China has been doing business with other countries. So the situation now is that ASEAN will continue to benefit from these supply chain shifts, right? Selling more to the US, selling more domestically as well, and China shifting its production, many companies shifting its production, not just from China, from US, Europe as well. You can see that from the FDI data that these things are still evolving and still developing in our favor, and China is doing a lot more with the region, and as long as China is holding up, we should be able to benefit from China's continued growth as well, because in China's scheme of things, what we are seeing here is that there will be some increase in the share of consumption in its business activities, right? So that is what our conclusion is for this consumption, that the share will be continue to go up. That means Chinese retail spending, consumer spending will be a lot more in the years ahead, and that will benefit companies operating in this space, supplying in this space. And that we wrote a report on this increase in consumption back in November. You can see the link below for more details. Right now, China's share is quite low. It's about 40% here, right? It's about 40% public and also private consumption. Other countries, a lot more. So there is a tendency, and also there's some policy support to move towards a higher share of consumer spending, right? So that is something that we can look forward to in the years ahead. companies operating in this space on the retail side and also supplying those companies in this ecosystem. That should be another bright spot for China. All right, so that is something we can look forward to, and some of these spending. The reason why people say that China not spending so much is because of non-discretionary spending. Non-discretionary spending is this part. Non-discretionary means no choice, forced to pay one, like tax. Non-discretionary spending is very high, and discretionary spending, like things that you want to spend on. Here on the right hand side is clothing, household stuff, and transportation, etc., etc. Those discretionary stuff, it will be healthcare, residence, rental, mortgages or whatnot, and food. These are the non-discretionary. Large portion of it is in there, but the chances of that is this share of non-discretionary is likely to continue to trend down. Why? Because, for example, residents, housing costs in the China have been coming down with the over the past 2-3 years of prices in residential prices coming off. So that means the cost of owning will be much lesser compared to, let's say, years ago, right? So that will free up money to spend on elsewhere, and also healthcare as well. The costs have been coming down as well, with centralized drug purchases by the Chinese government, etc., etc. So these are the factors that will favor a bit more domestic, or a bit more flexibility for consumer to spend, and that will also part of the uplift for economic growth, right? So the rest of others, for example, I mentioned about home prices, will be helpful in releasing a lot more spending into the consumer market, right? On the consumer spending, all right. So that is the picture here for Trump, for the Fed. We see 2 rate cuts this year, 2026, after 3 in 2025, and of course there's a lot of uncertainty. So keep a lookout for the kind of factors that could swing things around. Talk to your GM sales folks, and stay on our subscription. We'll update you on a daily basis on technical analysis of movements of various currencies, even interest rates, and also commodity prices. So stay on our subscription to see what is happening, and what is likely to go, what is the likely trend. And also, of course, Southeast Asia, the backdrop is still favorable, is still positive for us to do business in. And of course, China is an important part, and this year we should see China slowing a bit, but it's not going to be a major downshift. So things are still remaining positive, and keep calm, then we can carry on, right? So there's a Q&A box at the bottom. Any questions, please punch in your questions or comments, and we'll take a look later at the Q&A. Okay, with that, I will just stop here and pass the time to Peter for the FX outlook. Thank you.
Okay, thanks, Tekin, for your insightful sharing on macro backdrop on the globally. So in the next couple of minutes, I'd like to share a little bit on 2 areas. First is interest rates, followed by the FX market. So I think by now it's quite clear that in terms of interest rates, we are already in year 2 of the global easing cycle. So this year, our view is that most of the central banks globally are likely to finish up their easing cycles. So and Fed will continue to ease, and more likely this is going to be the last year they're going to do so. So you heard from Tekin earlier, 2 more rate cuts this year, particularly in the second and third quarter. So that coincides with after Jerome Powell leaves office in May 2026. So as to the pricing, I think this is largely in line with what the swap market is pricing in second and third quarter. In fact, the swap market is a little bit more aggressive, pricing in 1 more reduction in the fourth quarter this year. So nonetheless, if you look at interest rates from a high of about 5.5% in the US, we are on track to go towards 3%. So I think a key point that I would like to share at this juncture is that we are not going back to zero interest rates. Just in case some of you may wonder, should I wait for absolute low value? Can it go to 1% or 0% before I start hedging my interest rate cost? The fact remains is that even with a trade war last year, US economic growth, even global economic growth remains very resilient. So what more that right now the global trade war is wrapping up, and I think the prospects, the macro backdrop is looking quite positive for the start of the year. So as that, I think the overarching message we want to send to you is that we are not expecting any US recession, any single recession for this year at this juncture. So it's a very low probability event that interest rate will drop to recession levels of near zero. Okay. So on the yield curve, I think what we are seeing is that the yield curve continues to steepen. So the first observation you probably seen last year is that the inverted yield curve is no more. Yeah. So if you previously have been communicating to our salespeople, the salespeople always talk to you about there is a discount if you hedge in the belly of the curve and whatnot. This discount has evaporated across the world because the yield curve is reverting to a more normal situation where the long end is higher than the short end. So this phenomena will continue this year because if you look at all the easing cycles in the last 10, 20, or even 30 years, what is clear is that when you have an easing cycle, the yield curve will continue to steepen into the easing cycle and will be the steepest at the end of the easing cycle. So if we are nearing the end of the easing cycle, the yield curve will continue to be very steep. So why is that so, if you ask me? This is because that when the central bank ease interest rates, typically investors will say, okay, interest rates are going lower. It means that the economic growth in the future, in the medium term, should be brighter than now. So the interest rates on the medium term should rise to collaborate or to paint that kind of picture. So what you're seeing right now is that even as the short end of the yield curve in the US is anchored lower because of Fed rate cuts, you're seeing that the 10-year yield in the US is no longer dropping below 4%. So this is the reason why, because the yield curve is steepening. Yeah, so that's the reason why we have not really revised lower our 10-year US Treasury forecast below 4% at this point in time. So 4% likely to be the floor. And I mean, if you're in the business for longer term, I think to raise capital right now at the start of the year, in our view, should be a better time compared to the end of the year. Because if the yield curve continues to steepen, if you are raising capital at the middle part of the year, it's going to cost you more and more. Yeah. So in terms of Singapore interest rates, what we are seeing right now is that the SORA is no longer dropping. In fact, what this chart tells you is that if you focus on the orange line, that is the moving average of the black line, which is the very volatile SORA fixings that we have daily. Yeah, so the orange line tells you the trend of the SORA. And even after 3 rate cuts by the US in September, October, and December last year, we've seen that Singapore interest rate is no longer dropping. In fact, it's stabilizing. And this is consistent with our view that a lot of the transmission of Fed rate cuts to Singapore happened before the rate cut itself, not after. So when the Fed happens, when the Fed actually cuts interest rates, the SORA actually starts to stabilize. And in fact, for this year, one of our key message to clients, investors is that the SORA, which is Singapore interest rate, should bottom sooner than the Fed interest rates or the US interest rate. So like for the Fed interest rates, we are looking for SOFR to bottom between in the third quarter. For the Singapore interest rate, we are looking for a bottom in the second quarter. So you're looking to hedge your costs. I think the time frame to be looking at is the first and the second quarter. So we are not so far away from the low. So consistent with what I've just shared earlier, we are not going to look at a recession in the US, let alone Singapore. I mean, look at the growth in Singapore last year. It was phenomenal. The MTI forecast 4%. We came in at 4.4% on full year. If you look at, I mean, if you are in Singapore, you know that 4% is an outlier growth. And this year, one of the sombering truth, if the GDP is going to moderate back to about 2.6%. So that alone, what it means is that still very strong growth. 2% is still very decent. As such, when you have very strong growth, typically interest rates should not be so low. Only interest rates are low when you have a global slowdown or Singapore slowdown. That is clearly not the case at this point. Okay. So the big gap between Singapore interest rates and SORA, or the SORA and SOFR, has started to close already, meaning that even if the US interest rates continues to go lower in the next couple of months, we're seeing the possibility that the SORA could even turn up towards the US interest rate, because the gap between the SORA and the SOFR is very wide in historical terms last year. So look for the Sing rates, SORA, to bottom at around 1% before heading up to towards 2% by the end of this year. So a recap of what to expect this year versus last year. If you focus on the blue bars, those are the easing that happened last year. So a lot of central banks globally have eased interest rates. This year, if you focus on the red bars, still pointing lower for most of the countries in the world. But if you notice, the magnitude of easing this year will be lesser than last year. And the outlier, of course, will be on Japan. Japan is the only one in the world, in the major economies, that is still tightening. And this year, we are still expecting another 25 basis point of rate hike for Japan. And another message that you probably pick up in this slide is that most central banks probably have already concluded their easing cycles. These include New Zealand, India, Korea, and Malaysia. They have concluded an easing cycle. So this year, interest rates will stay where they are for the rest of the year. MAS, very important statement that I would like to talk about. We also think that the MAS have, after easing twice at the start of last year, we think that we have reached the bottom of the easing cycle. MAS will not ease further this year because growth is solid. Second is that there is signs that there is some reflation coming through in the system. So in fact, there are even whispers in the market that the MAS may even tighten in April if we see more signs that there is some inflation coming in Singapore. Okay, so without further ado, let's move into the main dish, which is the FX market. So dollar, clearly by now, everyone knows that it was a bad year for dollar, down 9% on the dollar index last year. So what do I expect this year? We are looking for further declines. Why? And it will still be driven by Fed rate cuts. But because of the fact that it is only driven by Fed rate cuts, the impact on dollar on the downside will be a lot more modest compared to last year. So last year we fell 9.4%. This year we are targeting from current levels another 3% for dollar index. So moving towards about 95 thereabouts by the end of the year, currently about 98. So why is it so lesser compared to last year? One of the main reasons investors must take note is that the major part of the drop last year happened in the first half. And what happened in the first half was that Donald Trump started the global trade war. And because of that, there was some de-dollarization flow. So everyone was a little bit concerned about holding too much dollars. So when that happens, the dollar becomes weak. Clearly, this story is over. I mean, no one talks about global trade war right now. And in this year, unless Donald Trump reverts back to the trade tension again, if not, there will be no black swan event like last year that is pushing down the dollar in a big way like before. So very quickly moving to different currency pair. Euro, we stay positive, but we have moderate our amount, our positivity. Clearly, after moving strongly in the first couple of months last year, euro is moderating. There is, I mean, at around 118, there's a very solid resistance that's building up. So the next target, possibly 120, and increasingly in the short term, we are looking at euro positioning that is building up. So that could be the precursor for a little bit more move on the upside. Yeah. For sterling, the uptrend is still intact from 2022. So if you can see the very steady uptrend on the blue line. But do take note that UK is still expected to ease a few times this year. 3 more times we expect. And that could cause some volatility because when everyone is stopping easing and you're still easing, currency typically will not perform that well. So that's the reason why, while we are keep to an upward trajectory for the sterling against the US, it's likely going to be two-way movement like what we have seen before in the past 1 year. Dollar yen will be very interesting this year. Why? Because if you have noticed, there is a big gap between dollar yen, which is biased to the upside right now, versus the yield spread, which is pointing lower. Typically, both goes hand in hand, meaning that if you have yield spread going higher, typically dollar yen will be higher. But right now, there's a big gap. So we think that this year, there will be a normalization of the big gap via dollar yen going lower towards the yield spread. So as you know, dollar yen nearer to about 157 to 160. These are sensitive levels which the Bank of Japan has previously intervened before back in 2024. So I would say that limited upside together with the fact that we are still expecting Bank of Japan to hike rates. So that could be another positive trigger for yen to strengthen this year. But it's not as straightforward as before. And we project dollar yen at 146 at this point in time by the end of this year. Aussie was a very surprise move that we've seen in the last 2 months of the year. The Aussie rebounded very aggressively, in fact, in November, December, predominantly because we did see some reflation or stronger than expected inflation prints out of Australia that caused everyone to flip from pricing interest rate cuts to pricing interest rate hikes for RBA this year. So that's caused Aussie to be supported, and not forgetting that the RMB is also quite stable in December, strengthening effect. So these are all positive drivers for Aussie. Going forward, still positive on Aussie, but we think there is a little bit of high. If you are still looking to buy, make use of dips to buy into the Aussie, because on our side, we are still looking for potentially for the RBA to ease 1 or 2 more times this year. Moving quickly to Asian currencies, last year, surprisingly, once again, it's a surprise year, even against a backdrop where we have a trade war, slowing exports and whatnot, a lot of concerns about China's slowdown. Most Asian currencies turn out to be positive and gain against the US dollar. I mean, half of the battle was won because the dollar was weak in the first place. But the other, we have to give credit that the GDP profile, which Teck has just shared with you for Asia, was remarkable last year. Like Singapore, which I just mentioned, 4.6%. Even China can meet their target of 5% last year. So that has caused the Asian currencies to strengthen. But more importantly, I think for China, for Asian currencies, often not, they look towards the RMB for leadership. And because the trade war ended as soon as, it was a very relatively short trade war. So you can see that once the RMB starts to stabilize, it also adds another dimension or another source of support for Asian currencies to rally towards the end of the year. So that's all the underlying factors. But because of that, a lot of currencies are right now running against their fundamentals. So if you look at the CNY, the CNY has reversed all the losses due to the trade war. If you remember, at the earlier part of the trade, in April last year, the CNY was as weak as about close to 735 thereabouts. and against the dollar. And in the coming months, as the trade war de-escalated, the CNY gradually gained its footing, and in December, it had it has even appreciated beyond the $7 mark. Right now, it's about 6.98 thereabouts this morning. So clearly, the economic worries of China are not changing very positively at this point in time. This year, we are forecasting 4.7% growth at this juncture versus 5% last year. So there's going to be a growth slowdown. And the RMB or the PBOC still maintains a easing bias on the currency, moderately loose monetary policy. So we don't think the CNY should be so strong going forward. So while it's strong right now, we think that the pace of gains going forward for the CNY should start to slow down going forward. So we are a little bit more cautious about projecting further one-way strength of CNY going forward. Yeah. So in fact, right now, we are witnessing some very unique situation over here. If you notice in this chart, the middle part of the chart where you have a solid blue line, that is the fixing rate. In fact, if you look at the last couple of years, it is a very, very rare scenario for the onshore, which is the black line, and another line that is below that you can't really see beneath it is offshore, to trade below the fixing on a sustained basis. So right now we are in a very, very unique situation where the market is forecasting CNY strength going for, or rather turning positive on CNY. This is unique because for the longest time we have not really seen that for a while. So if you are patient and you want to lock in your dollar requirements below 7 or just below 7 and below the fixing rate could be a very interesting level to look at. Yeah. For Singapore, just spend 1 minute on this. What we are seeing over here is that the senior has indeed pulled back quite a fair bit across 2025. This is alongside easing expectations, but has started to rebound or found a base and rebound because we are of the view that the easing has already been completed in Singapore, so that the senior should go back higher. And this is what we are seeing. So what does it mean for the dollar sing is that we think that the dollar sing should continue to go lower. We are forecasting 126 by the end of this year versus the current spot of 120. Ringgit, clearly the best performing currency, in fact, for a second year running in 2025. Closer to 4, we think that it should be a bit overbought to a certain extent. Notwithstanding that fundamentals remain very remarkable in Malaysia, but we think that gains should stall around here. We are a little bit more cautious about projecting gains beyond the 4 level. At this point in time, we would like to see how fundamentals are changing. But we are still forecasting the next couple of quarters for ringgit to stay around 4. For Indonesian rupiah, not a fantastic year last year. In fact, it was weakening. It was underperformer last year. We think that it should continue to stay on the weaker side because of bond outflows, and we are still looking at one more BI rate. We are looking for 2 more BI rate cuts this year, so that could exert some pressure on the rupiah, and it should continue to be under a little bit more pressure. But of course, volatility could be smooth because the Bank Indonesia is always looking at the FX market, and sometimes it does intervene in the market to prevent one-way traffic in the market. And last and foremost, Thai baht. The Thai baht has been strengthening alongside gold. This is quite a well accepted correlation between gold and Thai baht. And to the discomfort of authorities, I think Bank of Thailand is not really happy that the Thai baht is so strong because it is not reflecting the very sluggish growth potential and the prospect that the Bank of Thailand should cut interest rates. So I think closer to 31, I think that could be the bottom for dollar baht. More likely across this year, the baht may not be able to appreciate that much, even if the dollar continues to be soft. And with this, wrap up my session, and I'll pass the time back to Kun Hao, who will spearhead the Q&A session. Thank you for your patience, and looking to hear from you soon.
Thank you, Pete. Okay, so we have Tekin and Peter back for the Q&A, the final segment. We have quite a few questions from the floor. I'll just combine a few of them. First up, of course, is the obligatory Black Swan question. Perhaps, if I can extend the discussion, I don't think Black Swan is, a flutter this year, but we do see quite a few gray rhinos out there in the geopolitical space. And if I can be a bit more candid, right? This question goes to both Tekin and Peter. So what happens if in the next weekends, we do get exciting weekend developments in Greenland, in Colombia or Cuba, right? An escalation of various geopolitical risks. These are clearly gray rhinos because they are staring at us now, right? It shouldn't be a surprise to anybody in markets. Peter, you go first. Does that change your core view of a weaker dollar and still, gradual grind lower in rates if these gray rhinos occur?
Yeah, so I think for sure, I think it will complicate the narrative by quite a fair bit. Because if you have war, if it is construed to be a long-lasting event where it affects global GDP in a big way. I mean, if it escalates out of proportion and the whole world goes in recession, then I think firstly the rates narrative needs to change from a no recession template to immediately a global recession. So that argues for very low rates, 0%, 1% for US. So likewise, Singapore will stay low. So that will change. Once that change, the rates template change, of course, it will fit towards the FX market. And typically, it is very complicating because the dollar role as a reserve currency may start to go up again for a short period of time before the Fed starts to cut on an emergency basis. So we've seen that before during COVID, where the dollar can spike up first, because of safe haven flows before following the Fed and go lower. So what is clear is that if that really plays out in this way, volatility will definitely pick up. Right now, what we are observing is that the FX volatility, rates volatility is very low to begin with. Everyone seems to have a very preconceived notion of how 2026 should pan out to be. So this is something we like to warn investors. Remember last year where we entered 2025, we also came in with a very narrow view of the market. Everyone comes in with the view that, okay, Trump is in, trade war next. Trade war means tariff. Tariff means rate hike. Rate high means stronger dollar. And look how, in the span of 1 year, how everyone was wrong-footed to a certain extent because of the kind of template that we are fixed into. So I think the first warning I'll really shoot out is that do not get too complacent with the level of volatility that is right now, which is too low for comfort.
Okay. Thanks, Pete. Tekin, if we do get Cuba, Colombia, and Greenland, does that change your reasonably constructive view of China's growth and ASEAN's growth path going forward?
Well, okay, that will depend on how the situation pans out, right? So if you look at the past, last year it was Iran, right? Iran was struck, but I think it did not create a lot of problem after that because it was relatively short-lived. So here I will echo what Peter say. It depends on how long, how long the situation is persisting. So of course, obviously, the longer it is, the more I think concerning and the more volatility, and then we will have to do a lot more adjustments, right? So if you look at Venezuela, it was like over a few hours or something like that, right? So it did not really create much of a problem in the financial markets. Now, if you move on to other places, it may not be such an easy situation, especially at places like Cuba or even Iran. And then you add on, you throw in, let's say on China's side, and say that if US can invade another country, what is there to stop me from cleaning up my own backyard, right, in Taiwan? So that is a lot more, I think, black swan or gray rhinos that can happen. And again, I want to echo what Peter mentioned. Volatility is do not be complacent, right? So always keep yourself protected against all these unexpected events that could happen in just matter of days. Thanks.
Okay, thank you, Tekin. So moving on, there's a few technical questions, specifically two on growth outlook. Where one that basically asks, okay, why is our GDP forecast for Singapore half in 2026, right? And we know that last year Singapore GDP did very well, and the forecast for 26 is 2.6, about half of what it was. Then the other question is related to growth, but for Vietnam as well, basically highlighting the risks of geopolitics and more transshipment tariffs on Vietnam. So the question is, why do we highlight, why are we still constructive on Vietnamese growth forecast? So perhaps if you can bring up your growth forecast table, and let's try to give a bit more details to the growth outlook for Singapore and Vietnam. Thank you, Tekin.
Okay, sure. Good now. No problem. Okay. I hope you can see the table. Instead of the chart that I used earlier, I can show you the table. I think a lot more detail. I just want to correct what Peter mentioned earlier just now about Singapore is about 4.8% last year, right? 4.8. Much better than 4.4% that we did in 2024. Of course, the question is, wow, is half like this year 2.6 only? What's wrong? Actually, there's nothing wrong. What I would say to that question about roughly about half of what we had in 2025 is that not necessarily a bad thing. Do not take this. My advice is do not take this as a bad thing. 2.6% is still quite decent for Singapore. It is quite close to a potential growth rate of Singapore of about 3%, 3-ish%. So it's very close already, meaning, what is this potential growth rate? Meaning, if you look at a company, realistically, with the staff that you have and the equipment that you have, the sales channels that you have, how much sales can you do? Well, X%, right? So this is the X% for Singapore. It's very close to the X% of Singapore, given the population that we have, the trade linkages and the capacity, blah, 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 and all those things without creating problem. Of course, you can go above that, but if you continue, then you have to pay more to your staff, you have to do a lot, you have to pay more for materials and rentals and all that, and then it becomes very expensive and it may not make yourself more competitive. So for Singapore, 2.6% in 26, well, I think Jester deliberately put this number, 2.6 for 26. Okay, so for 2.6% is a decent number. Why is it the case? Because we had very strong year in 2025, and are we able to replicate that? I doubt we are going to be able to replicate the same momentum that we had last year. Not to forget, we had the tailwinds from these AI demand for chips and all those that benefited Singapore a lot. Pharmaceuticals as well, a lot of front loading, particularly on the pharmaceutical side and all those, and of course the supply chain shifts that have been taking place in Southeast Asia, and also we are benefiting from that. Are we going to see the same kind of momentum? Very unlikely, because the high base will start to have an impact on growth rate. So I rather see about a bit of slower growth compared to versus a situation where we are persisting with high growth rates. Right, 2.6% for Singapore is not so bad because of the high base. We are unlikely to able to very difficult to overcome, and also the kind of momentum that we had from last year may not be able to come in again this year. All right, so that's for Singapore.
So in any case, the long-term more or less average growth rate for Singapore is about 2-ish%, right?
Yeah,
so
that's right.
2.6 is good, right?
Yeah, 2.6 is good. Yeah, very close to, thanks. Yeah, very close to what we had in the past already. Yeah, thanks. Okay, for Vietnam just came out with their final quarter report for last year, and the numbers have been, we exceeded everybody's expectations and my expectation as well. The momentum was very strong in the fourth quarter of 2025. And then why is it the case? Because of very strong exports. The whole year of exports in Vietnam is about double digit. I think 17% increase, right? The increase was because of the demand coming out from the US, despite the tariff. And also in the middle of the year, we had a bit of a reprieve, what we call that, a stand down on the tariff rate back to 10%, but demand will continue to be strong. And all these front loading, so to speak, or people ordering ahead, have been taking place, and that benefited places like Vietnam, Malaysia, just to name a few, right? So Vietnam benefited from that. And of course, the FDI flows into Vietnam, another key driver, also very strong. So very high chance that Vietnam will be, sorry, it is not very high chance. The FDI flows in Vietnam, another record year. That means companies are pouring in investments to set up factories and things like that. So we had a very good year last year. And then going to this year, similarly, we are unlikely to see the kind of a momentum that we saw, right? So that's why I peg it down to about 7.5%. Again, quite a decent numbers. This is a very decent number, 7.5% for Vietnam, because at what we have kind of potential growth rate for Vietnam probably will be close to 7% or even lower. So 7.5% for Vietnam for 2026, I think it's not bad, right? Similarly for other countries as well, the situation is most of the countries are lower compared to the previous years. You can look at the column here. Most of the countries are lower compared to previous year, but the situation is actually quite a decent backdrop for many of these. Now, I just want to add one more point of the risk. What kind of risk I can derail Vietnam and others? One of the things I can think of is the export orders that we have been receiving are very strong. Now, if there's something wrong with the export orders, for example, sharply lower because the US consumer cutting back on their spending, therefore, smaller orders coming in, and then that will transmit to us with factory will be receiving less orders, therefore less exports. So that's one risk, cutting back from the consumption or spending by the US consumers, European consumers. Now, second thing is potential risk is, of course, tariff. Now, Peter mentioned about tariff. Now, people don't really talk about it. It's true, people don't really talk about it. People got used to it. But just in case anything that happened on the tariff front, right? Let's say if it's big enough, that could also swing the equation a bit. Most importantly is sentiment that could be affected, right? So we'll be seeing the US Supreme Court will be issuing the verdict, the ruling on whether the last year's tariff are legal or not. So that will have some implications as well. If Trump say that if it's illegal, Trump may resort to the US president may resort to some other measures that again could cause a bit of an issue on the trade front. So some of these risks, of course, the other last one is a geopolitical risk that I'm not going to repeat here that we discussed earlier. So a couple of risks that to watch out. Thanks.
Okay. Thank you, Tekin. Thank you for the comprehensive update. So I hope that solves the mystery of the Singapore growth outlook as well, and why we are still very constructive about Vietnam. Pete, there's a question on Korea One. Now, if I understand correctly, we have had conversations with a lot of South Korean customers, and it's always a very emotional point that dollar Korea is now still above 1,004, right? The question is simply, what's the outlook for the Korean One? And if I can extend that question, do you think the Korean One will ever recover and play catch up to the Taiwan dollar?
Yeah, I think a lot of the headwinds that the Korean won experienced last year may have already passed, or rather, I would say, on a more conservative basis, the peak of all this negativity may have already passed. So this year, we are thinking that the Korean won could benefit from a weaker dollar. So back to your initial question, yes, we are still forecasting dollar Korea back below 1,004 by the end of this year. In fact, we are targeting about 1,390. So
Okay.
overall, quite constructive. The race between Korean won and Taiwan dollar should come back on again this year.
Okay, good. That's good to hear. Moving on to another, interesting currency as well, is of course the Aussie, right? There are some whispers in the market that with commodity prices going higher, indeed, metals are higher, right? Iron ore, copper, all the key commodity prices are all higher. It may do Australia's economy much good, and of course RBA may not have much more room to cut anymore.
Yeah.
So you mentioned that RBA is still on the softer side, and of course, can you perhaps highlight again, the basis of our view, and where do we think Aussie rates and the Aussie dollar will go from here on?
Correct. So this morning, in fact, we just have the latest print on the monthly CPI came in a little bit weaker than expected. So this tells you that the upward trajectory for inflation in Australia may not be so straightforward. So it has caused also some market players to par back expectation of a rate hike. So that is one. The other thing that why are we still looking at interest rate cuts for Australia is because we think that the RBA may also want to look at the consumption side of the picture, which may need rates to be a bit softer to promote consumption. So that is our the main reason why we are still holding on to expectations of RBA rate cut against the market consensus at this point in time.
Okay. Okay. Sorry to put you on the spot still. One last question on the Indian rupee, right? And again, we have got conversations on this. The rupee unfortunately fell past 90 to the dollar,
Yep.
right? And it keeps depreciating. So what's our outlook for the rupee? Where do you think the rupee can go from here on? Is it in perpetual depreciation?
We are still of the view that the rupee should appreciate, but because of the steep move that we've seen in the past 1 month, going above 90, trajectory-wise, I think we are still inclined to keep that the RBI should have enough ammunition to keep the devaluation under control. Yeah, so that is our premise for keeping our view that the rupee could recover a little bit this year, but it's all tentative on what is the underlying reason, which is foreign investors are dumping bonds in India. So if this phenomena continues into the new year, of course, that could be another headwind for rupee this year. But for now, we still think that the broad dollar weakness should dominate. It's a matter of how much the rupee can appreciate or recover this year. Yeah.
Okay. Okay, thanks, Pete. There's a few questions on gold and silver, and I think I'll take that. So the question pertains to what's our outlook for gold next, and of course, what's happening with the record high in precious metals. Are we concerned about this as a sign of instability of the US dollar and escalating of public debt? Now, fundamentally, objectively, right? If you look at gold or silver or precious metals, there are basically broadly three broad groups of investors. You have the central banks, you have the institutionals, you have the retail investors. Now, what is happening in gold in particular is all these three major groups of investors are all lining up together for various reasons to buy gold very, very strongly. Central banks need to allocate more into gold reserves. Institutional investors are allocating more into gold ETFs, and retail investors, we all know, are buying gold bullion, gold jewelry. And there's a common denominator amongst all this, which is the need for safe haven diversification, whether it is for central bank balance sheet, whether it is, for our own investment needs. We need gold as a safe haven diversifier risk. And why is gold so important? Simply because other than treasury bonds or sovereign bonds, right, the only other hard asset that central banks own across the world is gold. And that is why it is such an important hard asset to have. And that is why it has been proven across history, across economic cycles, as a diversifier against dollar weakness, against escalating fiscal or public debt, so on and so forth. So the long answer to all these questions is yes, we're still very positive about gold, although gold is now very near our year-end forecast. We have a 4,006 and 26 forecast that we make in the fourth quarter last year. We thought it's already very aggressive, and we're now just barely $100 over away, right? This may trade by the end of the month. So suffice to say, the 5,000 psychological level is increasingly attainable over the medium term. I understand that a lot of investors, a lot of clients are very worried about gold. Now, do read our gold infographics report that was published just on Monday, that covers all the details as we discussed about central bank, retail, institutional buying, and where do we see the different drivers. If you need a copy of that, do ask your global market sales or your relationship managers for that. And again, don't be surprised if you see our next forecast update, pushing our targeted gold price a little bit higher. So that's on gold and precious metals. I guess to round off this webinar, perhaps I'll ask, again, one of the teasing questions to both Teck and Peter. Now, we've had a lot of, how should I say, negative and concerning discussions about black swans, gray rhinos, what can go wrong with geopolitics. I want to end this webinar on a positive note, right? So for Teck, can I ask you, what is your strongest macro call across the world, and why? Which economy do you think will do very, very well, right? And that all investors should not, how should I say, ignore despite all the geopolitics, right? And Peter, what is your most convicted FX view that we need to look at besides just shorter dollar, right? So maybe Teck, if you can help us with your strongest macro call.
Yep. Okay, sure. I think for me is that we are still I will be still positive on ASEAN, Southeast Asia, ASEAN, and that is, I think, if any place in the world you want to do business, things like that, I think ASEAN will be the place that that will allow you to do so in a largely peaceful manner, right? We don't worry about all this. Of course, Thai Cambodia is one thing at the borders, but otherwise, I think Southeast Asia is still I think I would say the bright spot in the world in terms of peace, stability, and also continuity. Right? Take a look at the Johor Singapore Special Economic Zone. The kind of buzz and activities that are taking place, and because of this stability and also peace and continuity, right? People are willing to come here. They're confident to be here, without getting disrupted by all kinds of crazy events. So this is a place to be, and the supply chain shifts again in favor of us, right? So we are exporting a lot more to the US, selling to the rest of the world, and we are also on our own. We have strong fundamentals to support that, right? Our population, our income growth, and all those things. So this is the place. I think Southeast Asia is a place to be. All these respective countries, of course, they are going to have problems of their own, but they should not be all these problems should not deter you, to look at opportunities in this part of the world. Thanks.
Thank you, Teck. So ASEAN is still the place to be.
Yeah.
Pete, your conviction FX call?
Yeah, in fact, our conviction FX call has played out in just the span of last month. So in our quarterly that we published in December, our key message for Asian currencies was that the sync crosses should turn around. And in the span, in fact, we made a bit bold call that the senior should bottom at 1%, as low as it gets. That was the 1%. This morning, we are trading at 1.7%. And in the span of 1 month, right now, people are even talking about tightening in April. So what this means is that Sing dollar should continue to strengthen or stay strong, something that we are very familiar with for the large part of last year, that where the senior can hug and stay near to 2% for a long period of time. So what this means is that Sing Ringgit, Sing CNY could potentially stabilize and turn up from it. In fact, these two crosses haven't really moved. The development in the last 1 month is that it has stopped dropping after dropping for so many months. So in the coming months, I mean, if the positive backdrop in Singapore continues to hold true, and the MAS doesn't ease anymore, then we could look at Sing crosses to start to perform again.
And the impact on dollar Sing?
Dollar Sing will be a little bit more muted because dollar Sing we are only seeing from 128 to about 126 at this point in time. So in percentage wise, not as exciting as the Sing crosses, to be honest.
Okay. So 126 for end of this year, right?
Yeah, correct.
Okay. Okay. So again, a big thanks to Tekin and Peter for the past 1.5 hours. There's still a lot of questions we didn't get to answer, right? And we have not forgotten about them. We will get the relationship managers and the global market sales team to get onto these questions. We'll work with them and we'll reply all of you, on all these remaining questions.